Hey everybody, welcome to once again another edition of Smarter Money Matters with your wealth doctor, Jeff Camarda, aided by my smarter brother, Jonathan Camarda, Chief Investment Officer of Camarda Wealth, and our super certified financial planners, Lou Vercel and Anna van der Leck. And we're going to begin with market and an economy update. There's been a lot of press, and I haven't printed it all, but a lot of press about how frothily valued the market is, particularly the U.S. market. This headline from the Wall Street Journal, 5 signs of a market bubble investors are tracking. And from the Financial Times out of London, Wall Street's euphoria sparks bubble warnings. And there certainly is no arguing that the market has really flown once again back up into space since the tariff scares earlier this year. So Jonathan, I know you spent a lot of time perusing these articles. What's your sense? By many valuation metrics, the stocks are, at pretty lofty levels. There's someone valued 1,000 times earnings, I think, or rather 1,000 times sales, which is even more earlier this week. But what's your sense?
Well, not so much my sense, just kind of looking at the numbers. If you look at the S&P 500 right now, we're at about a 22 PE ratio, price to earnings. You have 3 sectors that are really higher than that, elevating. You got technology at about 30, discretionary is about 28, and then I think you have industrials at 24. Don't quote me, I hold my memory. But below that, you do have some that are more cheaper parts of the market. So I think what you've seen is that we talk about lofty valuations, but it really is in a core small amount of stocks. Now, historically, when that's been the case, like during 2008 and such, we've seen that. We've had hard crashes, but it's not really happened over the last few years because of the way passive investments are, which we're probably not going to go into here, but it is a little idiosyncratic.
And it's still concentrated primarily in tech. I don't think you mentioned that in the 3 segments, but that's a big valuation.
Yeah, the MAGA stocks, maybe not even so much a MAGA, but right in that range where you're starting to get, your crypto, your technology, et cetera, stocks that are kind of carrying the weight. Underperformers, of course, have been your real estate. That may change. You've had underperformance, obviously, in your consumer staples. Now, believe it or not, though, consumer staples valuation-wise is priced at that same 22 PE as the S&P, and yet that is probably overvalued if you look at a lot of them. Those are what we call value.
But what's your overall sense? Because there's a lot of data there, and I'm not sure how much of it our audience will follow. But,
right.
A lot of folks, what Lou and Anna, are you hearing from your clients at Camarda Wealth that they feel valuations are stretched a little bit and concerned about that?
Yeah. Clients are definitely concerned, and that's one of the topics of conversations on our quarterly calls right now is just certainly talking about that. Yeah.
And how about you, Anna? Same?
Yeah, lots of questions around just how much some of these technology companies have grown in stock price and in value in just a couple of years. A lot of concern if some of these AI-related companies are actually sustainable.
And will become profitable because they're enormously expensive to run. So, Jonathan, I guess in a nutshell, because you're such a bright guy and have so many facts and figures at your disposal, you could find your way through the forest with a million trees, but some of us get lost. What is your overall sense of the momentum of price increase in the market? Do you think we're going to see continued increases, for the short term? Or do you think there may be some pitfalls ahead?
Yeah, interesting. This is generally a seasonally weak time of year, right? We go into August, and the market has continued to chug on. So I think the biggest thing that you're going to need to see, because we have seen a slowdown in some of the technical internals, as you mentioned, cash flow and such, and different metrics are slowing down. So I think to take that next leg up, you're going to have to see sustained momentum there. And one of the caveats is on the economic data. When you look at, we've had mixed data off of the tariffs and such, with CPI and PPI. So even though we have had a weakening labor market, the Fed, if they don't go really aggressively cutting in the fall, you could see the market potentially taking that fall and that pullback, which I think will be bought. We'll get into that later. But you could have a pretty decent retrace, and that would probably be healthy, and that would be during the season that you would expect it. So like some of the folks here are mentioning some of the concerns. AI is a game changer.
What did he just say? They thought that we're reaching a treacherous period. We might see some instability in the market. I think that's what he said, right? Is that what he said?
You could see some instability, but I think AI is a game changer, so the valuations don't apply the way they did in the past. This is a new terrain, and this isn't 1999 in the sense that valuations weren't there. Valuations are here, and the companies that are doing this are already Goliaths. They're not mini like Yahoo's back in the early.
All right, so I guess the distillation of that is that you're still generally bullish in this over the
Absolutely.
short term. Okay, good. And as we seg into kind of the economic forecast, I think everybody will agree the economy has held up, U.S. economy, a lot better than was feared with all the changes, particularly the tariff changes. Are you getting that sense, Anna or Lou, that our clients are concerned about the economy? Labor is weakening. It's hard to get a job out of college now. There's a lot of signs that the labor market is cooling off before AI is really replacing workers. You find clients are concerned? Or much pushback on that?
Not too much pushback from what I've heard. Anna, you can maybe speak on it. I don't know from your perspective. I haven't experienced too much of that lately. So
I think most of the clients that I'm speaking with, instead of being concerned about labor, more concerned about the potential for inflation because of these tariffs in their like everyday spending. Obviously, we haven't seen much of that yet in the data, but that is definitely a concern that they have brought up.
Yeah. Well, very good. Well, that was great. So until next week, I think we're at least our near-term perspective is not a whole lot of choppiness, but we are entering kind of a scary time of year on top of a lot of opinions of overvaluation. So the party may not go on forever, but hopefully it's not midnight yet. Okay.
Moving on to timeless wealth wisdom. Today's topic is what you can do when your insurance company denies your claim. A lot of folks are not aware that you have options, and increasingly insurance companies, they're for-profit companies, they're looking to make money. The more claim money they pay out, which affects what's called their loss ratio, the less profitable they are. So they certainly have an unfortunate incentive to not pay your claims, and we found that this has actually become pretty common. So what do? Well, we recently actually, Kim and I went through a situation where her mother had a reasonable claim, I think, and after going through the adjustment process with our not-so-good neighbor insurance company, the claim was denied. And a lot of people just walk away. She's 90 years old. She doesn't know what to do. But there is a function, an important function, called a public adjuster. And Daniel here is a public adjuster. He'll tell us about himself in a moment. And my understanding of their function is basically to represent the insured against the insurance company, understanding insurance law and what the policy says, and look for opportunities to refute the claim denial and get some money for the insured. Is that right, Daniel?
That's correct.
So tell me about, and why don't you state your full name and your company name so folks can look you up if they like.
Yeah, of course. My name is Daniel Mladen. I'm with Trust Public Adjusting Group. We're out of Daytona Beach Shores. That's our headquarters. I live up in Palm Coast. And we're licensed to cover the entire state of Florida. So.
And you're speaking to a national audience, by the way, but that's probably enough. I'm sure that we can find you. So tell us, basically, what is your function? What do? You get calls from folks like me a lot?
Yeah, of course. We get calls from a lot of different types of people. We work a lot with contractors that will refer us business a lot. But there's a lot of clients out there that have damage from the hurricanes or pipe breaks, fires, mold, lightning, hail. The list goes on. If it's covered under your insurance policy, then we can go after it.
Or should be covered. And you get a call like, at the beginning of the process or at the insurance company says, no, it's not covered. Look at page 16A. You slept too long last night. It's not covered.
Yeah, so that's actually a great question. We can get involved right at the beginning, and we can actually file the insurance claim for you. Or if you are underpaid or denied, we can then step in after the fact and take over and vastly increase your insurance settlement or overturn a denial.
Which is what happened in my case. Actually, I've used public adjusters a couple times in my lifetime, most recently with you now. But where we went through the process and had it inspected by the insurance company, they sent their adjuster out there and gave us, a not very believable reason for denying the claim. So typically, I'm guessing that's really when people, are motivated to come and find somebody like you. So what should they do? If they have similar fact pattern where Anna, one of our super CFPs, finds that a meteorite has fallen through her roof and the claim is denied, what should she do?
Well, she should definitely give me a call immediately and have me come out there, take a look at the property, and once our agreement is signed, we'll begin our process of writing our estimates And
So what is the process then? You go through any due diligence or, or field underwriting to see if there is a legitimate claim before you do all that stuff?
yeah, of course. I go out there first before having the client sign any contracts. It's no money out of pocket at all. So I come out there at first. We use Matterport technology to scan the entire property inside and out. And we also take a bunch of photos. And within that process, then I will determine whether or not this is a viable claim or not. If it's something that won't meet the deductible, and I can very much see that, I'm going to be upfront and honest with the client and be like, look, the damage is really just not here.
But if you read the contract, say, gee whiz, this looks like it should be covered, you got denied, then you go to work basically representing the insurer to try to get money to the insurance company, right? And how frequently would you say there are unreasonable denial of claims?
It's honestly more frequent than you would think or hope.
Half the cases you see, more than half?
I wouldn't say half of the time. I'd say claims get unreasonably denied probably at least 40%.
Yeah.
30 to 40% of the time.
And one of the triggers, that I remember from my certified financial planner studies back in the mists of the dawn of time, is that if you're aware of a problem, you see that there's a roof leak, say, and you just let it drip and drip and drip and don't do anything to remediate it, you're screwed. It's when you discover, you need to take action. Once you discover there's a potential claim, you have to contain it as best you can and not wait. Call the insurance company right away. Is that accurate?
Correct. Yes. Well, yes and no. So, yes, you should take action immediately and either file an insurance claim or call a public adjuster immediately. But for hurricane claims specifically, you do have 1 year to file the insurance claim from when the hurricane hit. It used to be 2 years, and before that was 3, before that was 5.
But the thing is the act of discovery that triggers it, right? If you see that, you can't just let it fester and get worse. If you're not aware of it, it could be going on for years, but if you are not reasonably aware of it, then that claim should still be viable.
Honestly, no.
Okay.
So it really just depends on where the water originated from. So if you had a roof leak back in 2022 from the hurricane back then, and you just noticed it now, it's not going to be covered because that claim is now, that storm is too old. But if you noticed it back in October, now, it still can be covered because it's within that statute of limitations.
Okay. And any concluding words again, because we're talking to people across the country, and hopefully we won't have concerns about hurricanes in Iowa for a little while.
Tornadoes.
Tornadoes, indeed. And tectonic plate shifts on the West Coast. But any parting words of wisdom as to what people should be aware of and when they should call a public adjuster?
Yeah. So we also do free inspections. So if you think you might have any sort of damage, just give us a call and we'll come out and inspect completely for free. And if you're worried about the hurricane that might be coming in the next week or so,
Or
we can actually come out there and do an inspection before anything happens.
Do you want to think with tsunamis? Or is that kind of out of
Well,
here?
yeah, we definitely can do it.
Excellent.
100%.
I have a question. So is your company national or they're just in Florida?
We're licensed in the state of Florida.
But the public adjusters, I'm sure, exist everywhere.
Yes.
So for those in Florida, why don't you repeat your phone number twice, so we can plug you a little bit.
Yeah, of course. My cell phone number is 860-335-7971.
That's?
860-335-7971.
Thank you very much, gentlemen. And just, the last thing I'll say is, hopefully you won't need a public adjuster because you got to pay a portion of the recovery to them and often some upfront fees. Hopefully you won't need one. So my suggestion is go through the claim process, see how you do. In many cases they'll pay it, they'll be honestly treated. But if you think you're getting, if it's denied, you don't think it's fair, by all means reach out to a public adjuster. They're really good at what they do. Any parting questions for Daniel? Thank you so much, sir. Always a pleasure. Hope to see you again soon. Hey folks, it's Jeff Camarda again with an afterthought on our story about using public adjusters when insurance companies deny your claim. You have to remember not all public adjusters are the same. And it's very important to be cautious when hiring public adjusters. Make sure you do due diligence and carefully review the contract before you hire them, especially if you have a valuable claim to protect. You may only get one shot. There's no fiduciary responsibility, I understand, with public adjusters, so be sure to find one that will keep your best interests in mind. So please be careful. There's a lot of reported misconduct in this space, just as there is for financial advisors. And while I've personally had good experiences with the two that I've needed in 25 years, one of our team reports that she learned the hard way, there's little regulation that governs this area. She's currently in a legal battle with a public adjusting firm that she had hired, and reports there's a real chance she could lose her entire home, which of course would be quite tragic, all because she says that she trusted the wrong company. So here are a couple of pointers on how to select have increased the probability of having good experience. Number one, of course, you want to verify licensing and credentials. Make sure the public adjuster is licensed in your state. You can typically verify this. The state's Department of Financial Services or the Insurance Commission or whatever they call it. In Florida, you can verify a public adjuster's license by visiting the Florida Division of License Search. Just verify Florida insurance license and Google that, and it'll take you to the appropriate sites. Look for certifications from reputable industry organizations like the National Association of Public Insurance Adjusters, or in Florida, the Florida Association of Public Insurance Adjusters. Check their track record and reputation as best you can. Look for online reviews on Google, Yelp, Facebook, and other places to kind of gauge reported client experiences. Ask for references from past clients, particularly those with similar claims. And I do a little bit of due diligence to make sure it's actually a legitimate client and not a shill that maybe has been set up to mislead you. And look for the membership in professional associations that have standards of professional conduct and ethical codes. Acquire about experience and expertise, particularly about the sort of claim that you're dealing with. See how long they've been licensed. Look if there's any misconduct on their license record, and ask about their skills. Finally, it's important to understand the contract and the fees. Typically, public adjusters get a percentage of the claim. Sometimes there are additional fees on top of that. Sometimes they're waived if there's no payment from the insurance company. Sometimes not. You can negotiate most contracts, of course, but it's really, really important to read the contract and understand it so you know what you're getting into. Beware of red flags, like if there's unsolicited contact, if they're chasing you, you didn't seek them out. If there's a lot of pressure to go ahead and sign up right now, if they offer you a guaranteed settlement, that usually smells pretty bad. And if they ask for upfront payments, particularly large upfront payments, would also be a red flag. And again, be very, very careful. Just as in the financial advisor space, there's a number of really good advisors like we think we are, but that's often way out, like Six Sigma, way out on the tail. The average by definition, top of the bell curve, is average, and mediocre if this is really good, and it's also a lot of really bad. So be careful. For financial advisors, I have written actually a chapter in my last book, a report called Screening for Smart Advisors That You Can Trust. And we'd love to send you a copy if that's something that would be useful to you or somebody that you know. Hopefully there's a float over link here or some mechanism for us to get that. Thank you so much. All right, so our next segment is something we're calling Wealth RX, Wealth Prescription, which is kind of a Q&A based on input that we've gotten from questions from clients and others. And a really, really interesting topic. Wall Street, big money managers have for years been trying to get the private equity and other non-publicly traded products into the huge 401k market, which is maybe the biggest investment market in the world. I don't know, but it's really, really big. And that's finally, the regulators have finally permitted this to where you're able to access private equity and other illiquid products in a 401k. So these will be coming to many 401ks soon if they're not already there. So let's first talk about the downside and some of the fear in the press, and then we'll talk about the upside. Right? I'm just going to read these headlines. This is from the Wall Street Journal this past week. Wall Street's big bad idea for your 401k. Recent moves by some alternative funds highlight the flaws of offering private assets to public investors. And Jason, actually this is a follow-up from Jonathan Weil in the Journal, How One Big Private Equity Fund Makes Its Numbers Incomprehensible. So I'm going to speak briefly about that. Actually, one, you talk about the upsides to private equity and alternative funds, which can be really, really profitable bets, right, Jonathan? What are they and why are they superior in some cases to publicly traded securities?
Yeah, no, absolutely. So I'm a little biased, studying this really for years in my younger years there for about a half a decade. And so this has always been a segment that has been reserved for the generally ultra high net worth folks. And because of the illiquidity, and I think Jeff's going to get into that in some of the negatives, and so the illiquidity means you can't get your money when you want it in layman's terms, creates a situation where the private markets have the ability to invest your money and not have to be controlled by timing of cash flows, perhaps like an equity or bond portfolio. So the beauty of that is that you have longer terms and you're not as susceptible to gyrations, that the managers can keep that money in play. And so for folks that don't need the liquidity, that really works out because they can just put a few million here, let that nest, and grow. So that's theoretically the positives of that. For folks that are not as well heeled, the caveat is that if they're not quite cognizant of that illiquidity situation, then certainly if they have a need to hit the ATM machine proverbially quicker, that can be a downfall, not the second tier downfall. The upside returns historically have been more attractive. Some of that is changing with the interest rate environment on private equity. And as such there, private credit, these are different niches that you hear, not to go too deep in the weeds. So while I do love the asset class for certain segments, I do tend to agree, although I am biased, that the Kool-Aid might not be as healthy for folks that, like I said, or might be in sandals as opposed to high heels as far as their wealth. Jeff can segment into that.
Yeah, there's a lot of flavors of Kool-Aid, and some of them are toxic, as you know, I hate to make that reference.
Lemonade.
The guy back in, I guess it was the 80s. But before I do, Anna and Lou, are you getting much questions from clients about accessing alt and private equity and private lending and that kind of stuff?
Not a huge amount, but those questions come every once in a while, sure.
And how about you, Anna?
I've just had a few clients, that have seen headlines ask, if this will affect their 401k, but from my understanding, it's just an asset class they can choose to invest in. They don't necessarily have to.
Don't have to, and maybe should or shouldn't. So just in the big picture is, these are the sorts of things that have been restricted to wealthier investors who are presumed, and not always, but frequently enough, are presumed to be sophisticated enough to do their due diligence and see if it was an appropriate investment for them. But here, the due diligence is like that ETF I bought with SpaceX in it. I've been trying to buy SpaceX personally, for a couple of years, and you really can't get any information. You kind of just got to trust them, and some are worth trusting, and some aren't. So it's a really treacherous space. But the upside is that if you get a good one, they can do things that publicly traded companies can't. And for one thing, they don't have to look at their numbers every quarter and what is going to happen in their stock price. The management focus can be much longer term than they're very reactionary. So you got to be careful, though. And one of the things, was today's Wall Street Journal actually, how one private equity fund makes its numbers incomprehensible. And Megan, maybe you can put this up on the screen so they can see it. But there's, the thing about private equity is you don't know what it's worth. The valuation is based on a formula or some kind of assessment or appraisal. It's extremely elastic. And as somebody qualified as Jonathan as a CFA to do valuations, there's a lot of dials to come up with the number that you want. So it's not, the public market, this is what somebody's willing to pay today. It's definitive. With private equity, it's a lot squishier, right? So this is, I'm not sure you can have to show this, right? So to disclose what the actual valuation methodology is, one fund, you can't see this. This is a little square in the paper with microtype with just numbers. And you have to read like 100 footnotes in the article and tie them back to this footnote. Well, nobody's going to do that, right? It's obfuscated, which is unfortunately a popular trick at Wall Street. For disclosure, well, we showed them, we gave them all the numbers. Not our fault they didn't look at it. We make it so hard, nobody's going to look at it. And that's the same thing as not giving the numbers at all. And it was another thing where they valued, in order to game the valuations, they took, say that we have a non-public trade, an alt, private equity fund that came out at 100, and now that there's a secondary market and it's trading in a market and you can buy it for 20. So there are funds that are actually buying it at 20 because that's kind of what it's worth on the market right now, but posting the values to 100 and showing this as profit. which I think is chicanery of the highest order. So maybe you can show that, Nick, because I think that would be very illustrative. So again, at the end of the day, this is a really, really rich space that is worthy of investigation. But as an option in a 401k, I don't think you can have enough information, and certainly not the analytic skill to make a good decision. So if you do it, I think it makes more sense to do with a private advisor who's able, hopefully, to do a lot more deeper due diligence. Any parting thoughts on that?
No, I mean, if you decide to do it, maybe do like a small amount, small percentage, not overweigh yourself in any specific class, just to be diversified.
But realizing, to Jonathan's point, these are not liquid. Sometimes you cannot sell them, or you get, the mechanism for what the valuation is if you got to get out, or some of them will take, will allow 10% of the fund to be liquidated per quarter, and after that the gate's closed. You can't get any money out. You really, really got to read and know what you're doing. Anna, do you have any?
No, just reminding clients and everyone, just do your due diligence. Just because it looks like it's the next new shiny thing, which there are some pros to it, just make sure it makes sense for your situation.
Absolutely.
Final word, Jonathan? And I said word, not words.
Yeah, I mean, it's a great asset space. Some of these funds may be more liquid, which may water down their returns. And also you have to ask yourself, why are they coming to these type of vendors? And I would submit that it's for the need of an influx of capital. So the vampire...
Translation is these funds, which are controlled by billionaires, have lots of money and political influence, they want to dump their product in 401ks because it's a rich market. That's the motivation.
Just like Amazon doing now grocery delivery. They just want to expand and make more money. Yep.
Well said. Thank you all for your input on that. And moving on to our final segment for today, which is Talkin Tax with the TaxMasters, and another disturbing article from this week's Wall Street Journal that I'm sure Jonathan has read profusely, is Blue States hunt for ways to wring more taxes from the wealthy. Let me say that again. Blue states hunt for more ways to wring more taxes from the wealthy. And it really is just astonishing with the passage of the big beautiful bill, the most recent tax reform for 2025, which is changing the calculus of the revenues that states are able to collect. So they're adding on additional taxes to kind of make up the shortfalls. Increasing tax rates on those making between $250,000 for an individual, the $500,000 for a couple, to offset expected federal funding losses from the new federal tax law. That's in Massachusetts. Massachusetts has collected and implemented income surtax of those earnings over $1 million and have collected billions of dollars on that over the past couple of years. So I guess the point is not there's another one called the Taylor Swift tax, I guess. They're taxing vacation homes over a certain value, and a lot of creative ways to pull more money out of affluent folks. And so be vigilant on this if you are in a blue state or a state that's got high taxes already. And the advice that I have, I consider tax to be the master wealth skill. And why is that? Because the amount of tax that you pay, this is something I learned in CFP school in the early 90s when I actually started doing the math, the amount of tax that you pay can be in enormous amounts, from surtaxes to excise taxes, to income taxes, real estate taxes, sales taxes. It adds up to a pile, and most people are oblivious to. So if you're able to convert, if you're able to legally avoid some of that tax, and I'm sure there's a lot of opportunities in these blue states, just as with federal tax law, if you're able to avoid some of that, it's like converting lead into gold. It's like pulling money out of the air and putting it in your pocket. So tax is such an important consideration. And Lou and Ann, I know that in your practice with Camarda Wealth clients, you spend a lot of time talking about tax. What are are clients sensitive to this? Do they appreciate that the leverage that tax avoidance can offer them?
Yeah, absolutely. I mean, tax kind of ties into a lot of different financial planning areas. So it's absolutely one of the hot topics that we discuss in our.
Anything come up lately?
We've been talking about Roth conversions and that type of stuff. That's kind of the kind of the bulk of the conversations. But Anna, you have.
I would say Roth conversions, and then just distribution planning. Where's the best account to take distributions from based on the client scenario.
We had one yesterday saying, gee whiz, if I've got my taxable account, why should I put the money into an irrevocable trust, you know, and not spend my IRA? And that was a good point. You could do the math to see what the least taxing, you know, transaction pattern is. But I tell you, if you figure out tax, if you have the opportunities, particularly for real estate investors or business owners, you know, there's an enormous potential to reduce tax across the board. You know, I know one of Lou's favorite examples is the business owner that puts his, that files his business numbers on a Schedule C, right? Why don't you like that, Lou?
Well, there's a couple different reasons. One, it's a red flag for the IRS. It's easy, you know, low-hanging fruit for the IRS to see that you have multiple sources of income, and you know, creates potential audit.
So what you mean is that you're putting your business numbers on your personal return, which is not required, but once if I'm an IRS, you know, examiner, and I have everything right here, and I connect this dot to that dot, you don't want to find out more about that, Lou, let me give you a phone call.
Right.
So you're providing information in a convenient format that's not required.
Yeah, I mean, avoiding payroll taxes, or trying to limit them on distribution of income from business entities. I mean, there's a lot that we can do, and a lot that, you know, TaxMaster does here for our clients as well.
Which I think is something that smarter brother Jonathan does, you know, which is typical. I don't want to speak, you know, for your personal tax situation, so I'll let you chime in. But typically, the recommendation or the prescription in a case like this is to set up an S corporation, which there's no taxes in S corporation, it passes through, and then take a salary in the S corporation, and you only pay Social Security and Medicare taxes, FICA taxes, on your salary. Whereas on a Schedule C, as a sole proprietorship, the way the calculation works, you're basically paying payroll taxes on the entire amount of profit, which in most cases you're not legally required to do. I've seen some people save $50,000, $60,000 a year on self-employment taxes, which is the same as FICA, except if you're on a Schedule C. It's called SICA, but it's basically tied in the same kind of payroll taxes. Anyway, that's great. Again, you know, in closing, and we'll have more of this, you know, in future Talkin Tax with the TaxMasters segments, and then some special guests that I think will blow your mind with their concentrated knowledge. Tax is one of the biggest opportunities to enhance family wealth that there is. If you know tax, the return on financial advice can be far, far greater than almost anything else. And on that note, thank you all so much. It's been a blast hosting Smarter Money Matters with the Wealth Doctor and his staff here at Camarda Wealth and TaxMaster. Thank you so much for watching.